Both inflation and economic growth are significantly impacted by interest rates. Interest rate adjustments by central banks, such as the Bangko Sentral ng Pilipinas, have an impact on the cost of borrowing for both consumers and businesses, which in turn has an impact on decisions about investment and expenditure. Interest rates that are lower tend to encourage borrowing and spending, which boosts the economy and may raise inflation. Higher interest rates, on the other hand, typically discourage borrowing and spending, which can both aid in reducing inflation and potential impede economic expansion.
One of the main tools the BSP uses to control money supply is interest rates, specifically its policy rate or key policy rates. The financial system's short-term interest rates are influenced by BSP's policy rate adjustments, which have an impact on lending and borrowing patterns, the money supply, and ultimately economic activity. For instance, the BSP may cut the policy rate to promote borrowing and investment if it wishes to boost inflation and economic growth. On the other hand, it might increase interest rate to discourage borrowing and spending if its goal is to control inflation.
The central bank engages in open market operations by purchasing and disposing government securities. The money supply is influenced by the BSP's open market operations, which also have an impact on the banking system's reserve levels. For example, the BSP adds liquidity to the banking system when it buys government securities from banks. This raises reserves may increase lending and the amount of money circulation. On the other hand, the BSP reduces reserves and potentially limits lending and the expansion of the money supply when it sells government securities, taking liquidity out of the banking system. Through its domestic open market operations, or DOMO facility, the BSP carries out open market operations in the Philippines. It purchases and sells government securities through regular auctions held in the primary market, including treasury bills and bonds. The BSP's monetary policy goals, including price stability and financial stability, are intended to be attained through these operations, which also manage the liquidity conditions in the banking system.
The amount of money that banks must keep on hand as a buffer against their deposit liabilities is known as reserve requirements. Usually, these reserves are kept in the form of deposits, with the central bank of cash kept in safes. Reserve requirements are an instrument used by central banks like the BSP or Bangko Sentral ng Pilipinas to control the money supply and maintain the stability of the banking system.
Lending capacity and liquidity positions of banks are directly impacted by changes in reserve requirements. Reserve requirements force banks to hold larger reserves, which lower their available funds for lending and may lead to tighter credit terms. Lower reserve requirements, on the other hand, give banks more liquidity to lend, which can promote credit growth and economic activity. Reserve requirements adjustments may, however, also have an impact on banks' liquidity management plans and profitability, since they may need modify their funding sources and balance sheets.